Good evening and welcome to the Australian Stock Market Show. Tonight's show is all about getting the highest returns, and to help you do that, we take a look at the top PE ratio stocks. We intend to share our expert view on PE ratios and, of course, as we do every week, our preferred stock picks. We will answer your questions about your favourite stocks as we aim to help you make better, more informed decisions. Hello, I'm Janine Cox, your host for tonight, and joining me is Gillham, and we're Australia's most trusted stock market educators. How are you, Mr. Gillham?
I'm really good.
That's good to hear.
I'm not allowed to talk about what I want to talk about.
Why is that?
Because you don't like me talking about it.
Your mouth is zipped.
Well, it is sort of zipped.
That's never stopped you before.
Well, it hasn't. Go Cats.
You can talk about it.
I went to the footy on Friday night. It was exciting.
Really?
86,000 people had a ball.
Oh, fantastic.
Geelong
did you have
lost,
your
but
pie?
I still had a ball.
Pie and a beer?
No, it's sushi.
Oh, did you?
Yeah.
Sushi
My
at the football?
No. It's code. Like, my wife texts me, said, "What did you have for dinner?" I go, "Sushi."
Yeah.
I might have a pie and a beer in my hand, but it's always sushi.
Fantastic.
Because that way I don't get in trouble. I had sushi at the footy.
Love
She
it.
doesn't know they don't sell sushi there. Seriously. But Janine,
Well,
so if your husband ever texts you saying, "I'm having sushi at the football," you know what's going on.
yes, well, that's a whole different topic altogether. Now, I have a quote for you all tonight. It comes from Thomas Paine, who said, "What we obtain too cheap, I should start again, we esteem too lightly. It is dearness only that gives everything its value." Now, Dale, I know this will hit a bit of a nerve with some people. What about you?
Look, I have to agree with all that. Quality over quantity in my book. You know, it's like, I've always been by quality, or always be prepared to say for something you value, because what Buffett says, price is what you pay, value is what you get. If you're paying nothing, it's not much of a value.
Well, I was waiting for you to say that, because you're always banging on about the fact that if people don't pay for it, then they don't value it.
I know. I mean, it just belies logic that people think they can get all this stuff for free and then still think that they're going to get a lot of value out of it, because they don't actually value it. They might think, "Oh, that's really great stuff that Janine and Dale are talking about tonight," but if they haven't paid for it, they don't necessarily understand the value that it could be to them. They just brush it off, and so that's really what it's about. But I do like the quote, so well done.
Okay, fantastic.
All right, now before we get into tonight's show, if you do have a question that you're dying to ask us, then all you need to do is simply text us on 0423 959 846. That's 0423 959 846. So just make sure you pick up your phone right now, get texting your questions.
While we wait for your text, it is the third Tuesday in the month, and this means that we normally take a look at world markets. So let's get into the charts.
Right, on the screen right now is the world currencies, Janine. It's the yearly list of them.
World
World
markets?
markets, sorry. I said a currency, didn't I?
That's my
There is
fault.
so
I confused you,
much,
didn't I?
I know you did. There's so much going on in world markets at the moment, isn't there?
Yeah, look, it's just very volatile, isn't it? And we're seeing that on the list there in terms of the change on the leaders board that's occurred. And I'm really looking forward to seeing you get into the relative rotation graph and explain what's going on there.
Is that a leading comment or what?
Yeah, I know. I've set you up there, haven't I?
Dump me into that.
But before we do, let's just have a look at that leaders board. And the NASDAQ 100 index is at the top, so up 14.8% for the year. NASDAQ comp is right behind that, 11.5%. We're seeing European markets, the CAC and the DAX, they're up around 7 or 8%, which is good to see. Asian markets are in the middle of the board at the moment, mostly. The Shanghai Comp Index, 4.7. But though we do have Europe, the Europe 600, 3.7% up for the year so far. The Nikkei stock average up 3.26%. Now the US market up 3%. What do you make of that?
Well, that's the S&P 500. The Dow's down 2.72. But because obviously what's driving the S&P 500 is the tech stocks, which is in the NASDAQ. So those big tech stocks, because out of your top 20 stocks in the US, I think 10...
There's
big
number,
tech stocks. You know, when you got the 5 of the FANG stocks,
what is it, 25% or 23% of the market?
Yeah, well, it depends on which day it is, but it's over 20% of the whole market cap of the S&P 500 is tech stocks, and they're in those big ones. You know, your Netflix, your Amazons, your Googles, your Alphabet, you know, Facebook. I can't remember all of them, but there's a few extra, and obviously Nvidia is up there as well, one of those big stocks. So they're driving what that Nasdaq is doing, what you're seeing on the screen there. But when you're looking at the S&P 500 is up 2.92% and the Dow's down 2.72%, something's smelly.
It is. Something's wrong
a bit
there.
smelly. It's like a bit of off chicken in your fridge. You go,
Okay.
where is it, and why is it doing this? Because it doesn't make sense. They normally, whilst one will outperform the other one, it doesn't make sense that they're like polar opposites of each other at this point.
Well, our markets, the All Ords and the S&P ASX 200 are
we're
actually
down
following
2%.
the US, and so we're down around the same level. I mean, really.
Yeah, so it's just, and if these things in the tech stocks taking off, or the small section of their market taking off, those tech stocks, how long are they going to run for? And what is the market wanting to do over the rest of the year? So it'd be interesting to see. And I know, looking at all the news in the US and across Europe and all,
It's doom and gloom, but whenever they do that, it's usually just...
It's doing my head in, Janine. And I imagine what the people watching our show, if they're getting into this sort of stuff, how confusing they would be about what's going on.
It's darkest before the dawn. That's the quote I was reading today.
Now, do you want me to go into the
I would
relative?
like you to go into that before we then go and have a look at the world indices charts.
Okay, so I'll put my glasses on here. Just to let everybody know who hasn't seen this before, I do this all the time on Talking Wealth for my market wrap, and on every single Monday I do, but I do it on the top 20, top 50, top 100 stocks in the Australian market. But it's looking at where the markets are going, and this sector here, this is all based on where the S&P 500 index is, or the SPX here, which is the US market, and what markets are travelling faster or slower than the US market. And you can see the XAO was actually travelling faster than the S&P 500 for a while, but they're all turning down now at the moment. So they're all likely to go down and come around here. So the markets that are moving right now, you're wanting to get anything in the Nasdaq 100, also the CompX, that's another market that's doing well. This is where the opportunities lie if you do invest overseas.
So lagging, moving into the improving area.
Yeah, you don't want to buy them in this area where they're already outperforming, because the only way when you're outperforming is to not outperform.
Well, look at the FTSE. I mean, it's turned down significantly, hasn't it? We'll look at a chart of the FTSE as well when we get into the charts.
Oh, absolutely. And this is, from this point of view, these are areas that at the moment they're going down. So they'll just go down for a little bit and then they'll come back up again. But New Zealand's coming right up there, and the SEC there, the Shanghai Composite's doing really, really well. But these are the two you should be looking at. If you're looking for nice short-term little runs on some stocks, and then you go down into the stocks within those and have a good look at it. But at this point in time, this is the momentum of mostly the world markets. The big ones are all slow.
All right, can we quickly get into some charts now? So first of all, what I'll bring up is we'll bring up the Nasdaq Composite.
Yep.
You can see there on the screen that the recent rise that we had off this low is around 21.8% to that high.
Very good.
The consolidation we're seeing here is actually a really nice little setup for further gains. So all this doom and gloom right now, I'm not concerned about that at all.
I'm not either.
It's just, I think there's a bit of smoke and mirrors, wouldn't you say?
Look, I think there's a lot of smoke and mirrors in the financial services sector. I think we're led to believe
so
a lot
then
of
that would
things.
mean that we're at the point in the cycle where if there is anything in trouble, everybody comes in to the rescue and they fix the problem, basically.
Well, they have to, because they can't. The world runs on money, basically. So if your financial system goes...
Well, it gets to the point where eventually they can't fix it, which is what occurs in a financial crisis, but we're not there yet.
We had that in 2007 to 2009. We're not going to have that now. We're not even in the right place to have that.
Well, there's
sort of
too
stuff.
much money around.
There's
at the
too
moment.
much money around at the moment, so I agree
All right,
with you.
so look, that was an interesting chart to have a look at. Then I thought we'd have a look at the FTSE, because that was one of the ones that was turning from that positive down, and we've seen this big pullback. But
that's strange, isn't it?
It's a big pullback, but still, I mean, it could turn around and go back up again. So we've just got to keep an eye on the FTSE over the next couple of weeks.
I mean, there's a lot of news about the Brexit, whether it was the right thing, and all those sorts of things happening there, but geez, you'd think the UK market would be taken off now. I mean, it's pretty much going sideways for the last 4 or 5 years.
Oh, I know.
So
it's
not
really
good at
lagged.
all.
All right. Well, thank you for that. That is it for our thoughts on the world market. So just a reminder that you can participate in the show by emailing in your questions, which we will answer in next week's show. For our YouTube viewers, if you want to see the full live show, you will need to head over to talkingwealth.com and subscribe. So join us there. With subscriptions at just $3.54 a week, that you just gain a wealth of knowledge as you watch hundreds of interviews with some of the best experts in money, business and mindset, and many other areas. And I've just had some great interviews recently and really excited about those. Now, let's get into the first email question.
Alrighty, our first email question is from Yas, and Yas says, now, hi Dale and Janine, I really love this show, and you guys, just the stock for the show, DHG. I'm not in this one as I haven't back tested it, but it looks to be a continuation pattern, just waiting for some confirmation. As always, this week's bar looks really good, so expecting a breakout in the next week or two. PS, love your stock market report, Dale, as it gives me insights on how you look at the market and not let our emotions get in the way, as I've not been the greatest at that in the past. Janine, even though I never got an email from you while doing the diploma, thanks for all the hard work and insights you put into the show each and every week. Maybe an idea for next show would be to stocks that have held up well during the sell-off. Thanks for a great show, full of great info. Regards, yes. That's a good idea, isn't it?
That's a really great idea. And in fact, when I read your email, I thought straight away, let's do that next week.
Yeah, Yes is really good. I mean, I was helping him, I was mentoring him a little bit in the last parts of his diploma course. So it was really good. He really came along really, really well. I was really proud of him. So, and obviously he watches my market report every Monday on Talking Wealth, which I just pull away.
So is he going on to do more study, or
I don't know. I haven't asked him that. Maybe you could
Well,
ring him up and
yes,
surprise him.
we will get to email each other if you do continue on and advance your studies further.
Well,
so I look forward to that.
There's throwing out a fishing hook, isn't it?
Well, I just had this great get-together with the advanced traders earlier in the month. So the online forum that we run was just a lot of fun, and now we're talking to each other. Is even more exciting.
And you didn't talk to each other before?
No, it was more like they sent messages through the chat, and now I can actually hear their
now
voice.
they use their microphones. So
you
let them talk to you. That's what you're
exactly.
saying. Okay. Well, can we get on with answering Yas's question now?
Oh yes, okay. Look, really
DHG.
great looking consolidation that we're seeing.
He's not in it. He's back. Going to
He's
back
not
test
in it, and it's pulled back so strongly. Look at this one. It's quite. Now, if we bring this right down here, we can see a 60% decline, which is in the right sort of area. We'd expect that generally stocks will start slowing down. Sometimes they continue to fall to around 75%, but often they'll turn around. So we're seeing this consolidation. This could be the start of the next rise, couldn't it?
Yeah, it's possible. It is possible. One thing that worries me, though, is obviously this low is there in December. Remember, the market was moving up October, November, December. So it actually came down through in December. So it's not doing exactly what the market did. This looks a lot better, but is this more just a resistance level? Will it fall away again, or will it rise? I'm going to err on your side.
Go bullish on this one.
Look, I think he's right. I think he's looking at it the right way. I do encourage him to do his back testing, which he said he's got to do before he does look at it.
But it's not ready yet, is what he's saying, because it's still consolidating. But what if it takes out this low? Obviously, we're thinking that, just avoid it for a while.
Well, I would be, yeah, absolutely.
Go back to the drawing board.
And I know when he's done his back testing, he showed me his back testing, his trading plans, he's done some really, really good work. So to me, this is the beauty of what we see with people when we start to mentor them. We see them coming from, I won't say places of confusion, but not knowing. And all of a sudden, it was just like we just keep turning light bulbs on, and we start seeing their work, and they start growing from that, because it gives them much more confidence to know what they're doing is working, because as we work with them, they're seeing more and they're seeing more and seeing more. It's like getting on a boat and getting out into the water, and you're going, okay, well, there's the horizon, but when you get to the horizon, it's not there. It's moved further again, and you keep seeing more and more and more. And I think he's done an amazing journey to get to where
it was going to be funny, but that's sort of my type
I was funny
of analogy.
before. You can't have funny all the time, because it gets boring.
All right, never gets boring with you here.
Can we move on now?
Okay, let's do that.
Have you had enough?
Yes. Look, I just wanted to say one more thing. I did think that little consolidation is like one of the things that we talk about in the stock market is how things are not random.
Correct.
So in looking at this chart here, we can see that it's very much not a case of random, because if it moves up from here out of that, we've got this beautiful little pennant pattern there, consolidation. So it'll be interesting to see whether it actually meets some of the rules that we teach in the course for that upside.
I think he's spotting a good one at the moment, but again, just do your back testing and and you know, really have a good look at it, because I'm confident you'll do a good job of it anyway. Now, if you do have questions like Yaz does, you can always email us. Remember, info@wealthwithin.com.au. We're happy to answer your questions. But now we've got a text, and this one is from Jack, who's asking about WDS. He says, "Hi guys, WDS has fallen. What are your thoughts for the long term? Regards, Jack." So let's go and have a look at WDS. So this is Westfield, yeah?
All right, Jack. Now, long term, I think it's good that he's raised long term, but then should someone be in looking long term at a stock like this?
Look, I think this sort of a stock, I mean, you can see how bearish it's been for such a long time. And look, I think this is not a long-term buy and hold type stock. You know,
Because of this big pullback here.
So, yeah,
Yep.
I mean, Woodside is really, it is a trading stock. It's one of those stocks that will always be a trading stock. It won't be a long-term buy and hold stock. You know, you really do need to make sure you've got good rules around it, good strategies around it. Get into it while it's running and then get out of it. That's really what you've got to do, because it has some massive, massive runs. So if you look at this sort of run through here, that's a massive run right up to there. Look at that, 155% between roughly April.
77? Is that?
Through to November.
You've got glasses on. Oh, sorry. I can't say get your glasses.
6.91% to be exactly.
Okay.
But it also can fall out of bed a little bit. I mean, you know, looking at the recent fall, you can see here, you know, just about 22% fall since November last year down into this low here. It doesn't look super fantastic to me at the moment. I think it's possibly got a little bit more to go. But it's a great stock if you have good trading rules on good strategies. And I know we talked about that on our podcast, which we released on YouTube yesterday.
Actually, we've done a few on strategies lately, haven't we?
Yeah, we've done a couple because we wanted to come at the area from multiple different angles. And so yesterday we released a YouTube video of the podcast. So we talked a bit about 3 key areas for developing your trading strategies and your trading plan. The podcast is out today of that, so we do an audio of that, and obviously the video goes up on YouTube. So if you haven't seen those on YouTube, there's one we did last week is for people who have been trading for a while, a bit hit and miss and maybe not sure what's going on with their trading and how to fix it. That was, I think, last week that went out, or the week before, I can't remember, but they're really great videos for people, and audio obviously as well, because they go up on our podcasting. But go and check them out, because they really will help you understand what the steps you need to do to create a great trading strategy and great trading plans and get more success in your life. But now we need to move on, I think.
Okay,
yeah?
yes please.
Okay, so unless you got more to say.
I've always got more to say, but I think someone's going to be yelling in my ear.
I think I better punch you and say, shut up. Okay, no, I could not say that. Somebody will yell at me. But now it's time to get into our topic tonight, Janine, which is all about buying stocks with the highest potential return. And here we're going to take a different approach than we normally do. We're going to take a look at PE ratios. We also get into the question as to whether it is better to buy stocks with low PE ratios. We'll also share a simple way to use PE ratios in a stock selection process so that you can gain better results.
Well, that's all exciting, isn't it?
I know you're jumping out of your skin, aren't you?
Yes, I am.
Absolutely jumping out of your skin. I think we've got some awesome stuff to cover with PE ratios, and it's something we don't normally cover, is it?
I know, it's more the fundamentals. So how about we just jump into this topic and give everyone some background on PE ratios. Now, firstly, fundamentals like PE ratios can be great as part of a simple stock selection process for helping you to narrow down a watch list of stocks to buy.
Well, they do that, don't they? I mean, that's part of the process, isn't it? We talk about fundamental and technical processes to narrow down. We have a fundamental top-down analysis we teach people for screening stocks. We also have a technical one that we do. But then once they do that, we can marry all that together, and that's what we talk about through our courses and everything else. But I do, to me, I find what a lot of people do is they get overwhelmed with way too many stocks that they're trying to analyse and look at, whereas what we're teaching them is to narrow all that focus down, and by using things like PE ratios and other things to do it better and easier. Okay?
Now, before we go too far, For the beginners, a PE ratio simply means price-earnings ratio and is the current price of a stock divided by the earnings. Now, it's widely written that PE ratios are used to determine whether a stock could be cheap or expensive. So the theory suggests the higher the PE, the more expensive it is. Now, Dale, what we often see is that this creates a lot of confusion for investors.
Seriously does. Because what's a high PE ratio? What's
Exactly.
a low PE ratio?
Yeah, exactly. And, one of the things I found interesting is that over time you actually have to monitor it, otherwise you've got no idea what that is exactly.
Well, it is. And you get people that go, oh, that's a high PE ratio. And I say, compared to what? And they go, oh, well, I've read it in this book. And I went, well, was the book for Australia or US? And generally they're trying to compare US PE ratios to Australian PE ratios, and you can't do that.
Yeah.
And so that's where it causes a lot of confusion. So, but what is over and undervalued? That's really what it's about.
Really what it's about. Yeah, and you can use a PE ratio to compare a stock to the broader market, the sector average, or individual stocks within the sector.
I love doing that because it really helps you get that. Like we talked about on our podcast the other day, it was like, you've got to work out where you are and where you're going. So what is cheap, what is expensive compared to what? So yeah, but you've got to compare the health. I mean, how do you compare a mining stocks to a healthcare stock?
Yeah, that's right.
Like they're completely poles different. So
But some people try to.
They do, but it's not really possible.
I know. Let's first take a look at the PE for the broader market to see how the Australian market is tracking relative to historical averages.
Okay, so we're going to bring up a graphic on that.
All right, yes, please.
So, is that the one you want? No, that's not the one you want. There it is. That's the one you want, isn't it?
That is the one we want. So, look, at the moment, the PE ratio is, I think, around 16. The average is typically around 15. That graph's probably a little bit behind.
So this dash line right across here,
yeah, you can see
that's the average?
That's the average, and you can see that in 2020 there's a line there. So we can see the huge volatility that's happened around that time and after as a result of COVID and what's gone on since then, which, when you look at it, totally eclipses anything that's happened on that graph that we've got there, and probably all the way back in history, I would say.
That's 42, 43 years, and we've never seen this big poof like that. And this is what we show highlights why we keep saying that the COVID crash correction was just completely out of the box. It was completely, you couldn't forecast it. And so to me, this just really
hits home, doesn't it?
Highlighted just, this is not normal. I mean, this bit here's the 87 crash through here. Here's the 2007 crash through here. Here's where we went from 1990 to 1991. We sort of double bottom through here.
And that was the wake after the 87 crash.
Yeah, we've had the tech wreck in here somewhere. And
that was the pyramid collapse in the early 90s, wasn't it?
Yeah,
94?
It was about 92
to 94.
No, about 92-ish. So there but this unusual, very, very unusual. It just shows you how unusual the COVID low was. But I think, that does show people, but we're roughly average PEs right now.
Well, it was interesting to see where our market is tracking now. Dale, it's worth sharing a comparison of the PE ratio for a stock versus the market and the sector, as we often compare how the individual stock is tracking to the sector when determining whether it may be over or undervalued.
Well, that sounds good, but that sounds like a gobbledygook, doesn't it? To most people, it's like, but you have to do that. You got to compare the stock to the sector, to the market. What's average? What's good for that sector or that? Like mining sector, what's average for the mining sector, but compare that to the overall market, and is it, can I say, talking apples with apples?
Yes, I think that's really a wise and simple way to do it. I mean, you have to be comparing the same thing.
We do.
With the PE ratio.
So we're going to show people a graphic on that soon?
Look, I think...
Or we're going to do it now?
Well...
it's up to you. You're running the show.
What would you like to do? You're the chief.
You're just passing the buck. Well, how about we talk about on the screen right now? We're going to talk about, this is BHP. No, we're not going to do it now. We're going to keep going.
Yep.
We're going to bring it up later.
Okay, well, look, thought you would never ask what's next.
Well, I am asking what's next because
you didn't ask what's next.
Well, you're confusing the hell out of me at the moment. So.
Okay, Dale, now let's have a look at the stock's PE ratio versus the market average and sector average. On the screen is the data for BHP from Macquarie.
So we are bringing out the graphic. No wonder I was confused.
Well, It's hard for me because nothing was happening for me either.
Geez.
It was just a blank.
Have you been drinking? You're
No.
getting me confused. This is morning. Now, I got this out of Macquarie Broking.
Yeah.
Now, a lot of broking websites will have this stuff and get data from Morningstar. So I just want to tell people that. But you can subscribe to Morningstar as well. But you can see here, we're looking at PE ratio here, and it says the company PE ratio for BHP is 8.22. The market is 14.6. The sector's 10.49. So based on this, it's undervalued compared to the market and the sector.
Yes.
Based on this. And you get all different other ratios, PB, P ratio, growth rate, all sorts of different things, dividend yield.
But we've
and
seen
EPS
we've
is down
seen
the
the
bottom.
PE ratio on the big miners has been low for
Yeah.
quite a while.
Yeah,
And yet, they're some of the most volatile stocks on our market at the moment.
they are. Very
So
much
is that, indicating that there is some concern, or is it indicating a huge
Well,
opportunity? It's not
If we
clear
go
at the
back to the
moment.
graphic, have a look at this. They also put what analysts are saying here. So if this is undervalued, why isn't this a big, strong buy? It's got 12 analysts saying to hold, 6 are saying it's sell or underperform. Only one's got it as a buy, and another 5 got it as a strong
Well,
buy.
that comes back to that point before, that the low PE doesn't necessarily mean that it's a huge opportunity to buy right
Correct. So people would think, well, that's a low PE. That's, it's lower than the sector, much lower than the market average. So why isn't many more analysts are recommending it as a buy? And that's why people get confused. So, okay, is that enough? Do you want to
now.
say more?
That's great. I think you've done well. Now, Dale, I wanted to chat about low PE ratio stocks. And what is a good PE ratio? Let's take a look at a list of low PE stocks from Market Index. Then we'll examine a couple of stocks from the list.
Okay, only a couple? Is that what you want, a couple?
Look,
That's not
all
like
right.
you, Janine.
It's really a dozen. Let's take a look.
All right, so on that screen, so that's Market Index website.
Yes, that's the Market Index website. So, as we know, this is a really good website for just doing a little bit of research to find out some of the things that are going on.
Marketindex.com.au, it's free.
Yep. And here we've got market capitalisation there on the right-hand side. So I've just put them in order of the biggest stocks at the top first, because as people know, we tend to just bring up the quality versus bringing up the rubbish at the bottom, can I say?
Yep, so you did a PE ratio search.
So we're looking at this. Well, actually, Market Index help you even further, because they even give information about low PE ratio stocks, you see. So it's a table full of low PE ratio stocks.
This is better than a beer on a hot day.
Okay.
Okay.
So you can see here that ANZ is the biggest one on the list in terms of market cap, and its PE is 9.73. Now, I think that's interesting when we're talking about PE ratios and banks, because historically we know that banks tend to be around those either low single digits or high single digits or low double digits.
Yes.
So to me, that's nothing out of the ordinary at the moment for a bank.
Yeah.
Woodside is surprising because that's really low for a growth type stock, isn't it?
Yeah. Oh, yeah, that's hugely low.
Yeah, which is what we saw with BHP. It's like the market, it's been tipped on its head completely in terms of where the PEs are at the moment. So South 32 is 8.2, and that's
Very
an
low.
interesting one. So there's quite a few here. Pilbara Minerals, BlueScope Steel, Spark New
We'll
Zealand.
talk about BlueScope later on, actually.
Yeah, we're talking about a lot of these. Yancoal Australia, Ampol, Insitec Pivot. I mean, the list goes on. If we look down here, we've got the retailers down here.
Wow, it's 6.
6 and 8. Now, the thing is, you've got to really look at these in context with historical data on
Yes.
PE ratios. So, we talked about before how the miners historically have been much higher PE ratios. They're growth type stocks, and
Yes.
that means that the market's more thinking that the earnings are reliable, and therefore the stock's more likely to be stable.
So what you're saying is don't just go and buy the top 10 stocks with the lowest PEs.
No, that would be just the totally wrong thing to do. But I would be interested. I'd never just agree with what Dale and I are saying, by the way, because it would be really interesting to do the study and take these stocks, because we haven't been here in this market. No one's been here in this market at this time right now.
No.
Right? You're never going to get the market doing what it's doing the same way exactly today as it will down the track. So the point is, if you take this data and you actually then look at this, say 1 year, 2 years down the track, and see where everything's tracking and compare that to the chart, that's going to tell you a lot about what this means in the future and how you can use this data in the future. Unfortunately, you need to have that water under the bridge and time
You do.
Because we were looking at the data back in the GFC and finding a lot of interesting things in the GFC, and stocks were looking cheap and yet they weren't.
Yet they weren't.
So this is where you have to be careful.
Yeah, and I mean, the market's been abnormal, I suppose, the last 3 years, hasn't it, really, since the COVID low. So, but, you know, Janine, I think we better move on.
All right. Now, that was a lot of fun, actually. I really enjoyed that.
I can see you getting excited about it, and I thought I better wrap you up, otherwise we'll never get anywhere. Now, you do have a strange idea about fun, Janine. Very strange.
Yeah, thanks for that. Now, a high PE ratio can indicate a stock is overvalued, but it can also suggest that the market expects a higher rate of growth in future earnings. So this is typically when a stock is being priced higher than, say, the market average or the sector average. What stocks will at times fit into this group?
Well, we already talked about some of them, like growth stocks, like your BHPs, your Rios, you know, if South 32 is one of those. So they tend to be growth stocks. They tend to be some of those tech, biotech type of ones, you know, the pharmaceutical type of stuff, the small cap type companies, those sorts of things that have some of those, you know. And another sort of group would be more of those stocks that are newer to the marketplace, you know, that sort of stuff as well. So, but yeah.
Where they've got forecasts for growth, but they haven't proven themselves yet. But there's a lot of...
Do I get an elephant stamp for all of it?
Oh, look, if you need one, I definitely can. Put your hand out, I dare you.
I need an elephant stamp. Don't hit me too hard.
I'm sure our viewers will appreciate hearing that information from you, because PE ratios can be so confusing.
Confusing, yes, and at times way overused, or should I say way over relied upon.
Exactly. So this is why we teach investors about this topic and how they can be caught out if they make a decision on a stock using the PE ratio in isolation, and say looking for stocks with a low PE ratio and thinking that they must invest in them. It's just not the way to think.
So true, so true. It really is, because it's just one of the things that you use to find stocks, not the thing you use to buy the stock. And I think that's what you're saying.
Yeah, exactly. Or in some cases, they look at stocks with PE ratios higher than the market average and avoid them. So how about we take a look at a few stocks from a low PE ratio list, as well as a couple with higher PE ratios, and consider what the chart indicates.
Well, I love it when you do that, Janine. It's such a great research, and I always get a lot from it. And I'm sure our viewers get heaps from it as well.
I can see you're excited.
I'm jumping out of my skin, can't you see it?
Okay.
So we're going to go to the low PE ratio stocks. So you've got to bring up the charting software now so we can have a look at all of that. So what's the first one?
Okay, now
so these are two low PE ones?
Yep. I have to stop at 2, don't I, for now? First of all, ANZ, right? That was the first one on our list. It was the biggest market cap one on our list. Now, we have seen over time how this stock has just basically done nothing. It's traded sideways. We've looked at, I think it was last week, we looked at the banks and all the returns, didn't we, year on year, to see what they've been doing to get an appreciation in the bigger picture sense. But at the moment, it's not looking great, given it's taken out this low. But could this be the low coming in right now?
Well, it could be, but I think it looks like it's going to break that recent low.
Well, it has broken that. It's just all a question now of whether it's ready to turn back up or not. That's the question, isn't it?
It's possible, isn't it? It is possible, but it hasn't really looked good for the last 12 months, has it?
No, it's actually been struggling for the last 12 months.
And
so
my question is whether it'll break that low from June last year. And if it does, if it does do that, it probably wouldn't do it by much. But then I think it'd be a great buy from there.
Well, we just need to see it kick back up again to get an indication of what's next, don't we?
So you got another one?
Yes, we're allowed another one. So Woodside, market capitalisation 60 billion, the P was 7.4. This was as at yesterday's data. Now, I'm just looking at the chart of Woodside, because we looked at it before with that person's question. Now, right now you could think to yourself, well, it looks like it's got further to fall, as we said before. The PE ratio is low. We know that as the price drops, obviously that's going to have an impact on the PE ratios. So, but a stock like this could flip really quickly. Do you expect that it could just turn around and trade sideways from here?
Look, I think it's going to find some support sometime soon. I think it really will find some support, because it really doesn't. It has fallen quite heavily, as we said, but there's a huge area through here, right back through to February 2022. Massive big area there that could find some support. But if you look at the big monthly chart here, look at it. if I go through here and I
But
just put
I mean,
my little,
I guess the big picture point of view here is really with ANZ and Woodside, with low PEs right now, and the question is, should people be buying these stocks? We can see the charts actually confirming no.
well, no, you don't.
So if someone was blindly looking at the PE and thought, ANZ's a great stock, its PE ratio's low, Woodside's a great stock, PE ratio's low, should I buy now? Looking at the chart, it says...
Do you, if you go and buy a book, do you just...
Read the cover?
Read the cover?
No.
No, you don't. There's a whole story that's to be told. So the PE ratio might just be the cover to get you. It's a nice cover. It attracts you to that stock. It's like, oh, cool. I'll read the back. I'll read the front. I'll read the forward. Now I want to read the rest of the book because I want to determine whether it's a great book. So the PE gives us that shiny, sparkly thing to go. Yeah, this could be good.
What's interesting is at certain times in the market, at certain times in the cycle, the PE ratio may be really easy to use the PE ratio to select stocks.
Yep.
But right now, it's clearly not the case.
It's one tool. It's one tool, but it's never a buy tool for me. It's always just how to find stocks.
Yep.
That's what it's about. But we'll go into that a little bit more a little bit later. But before we do, Janine, before we get into more stocks and share a view on them, we do need to say goodbye to our YouTube viewers. So if you are watching the show on YouTube, you can still watch the whole 75-minute show by heading over to talkingwealth.com and subscribe to that. As we mentioned before, it's just $3.54 a week, and for that you can watch this whole show and our Australian stock market show every single week, which is worth a membership on their own, or both those shows are worth a membership on their own. But membership also gives you a lot more than that. There is a wealth of knowledge in hundreds of interviews from leading experts from around the world on a range of topics, from investing, retirement, business success, mindset, and the list just goes on. We know you still have questions. Also, so in order to support you, our YouTube video viewers, or our YouTube loyal viewers, sorry, please still send us in your emails for us to answer, which we will do so next week. So simply email info@wealthwithin.com.au with the subject line Wealth Within Live.
For those watching on talkingwealth.com, you can relax and stay tuned, as you will love what we have in the next part of the show. We have lots more stocks to cover, more questions to answer, and a host of other great content. So stay where you are, as we will be right back after this short break.
Now, unless you've been living in a bubble, you'd be aware the Australian stock market has been falling over the past 5 weeks. One of the most powerful emotions driving our financial behaviour is fear, which causes investors to panic and make irrational decisions like we're experiencing now. While most investors know that reacting to our emotions is not the best strategy, unfortunately, most don't know how to change their behaviour. That said, overcoming fear is essential if you want to make rational decisions based on sound investing principles. A lot of people will try and buy on market dips. You know, they talk about buying the dip or when the market's coming down and loading up their portfolio. But I always ask them, well, how do you know it's just a dip, a short-term dip, rather than a long-term pullback? And you never know. I could be overly bullish at the moment because I don't think our market is that bad. What we're seeing is a bit of an overreaction to what's been going on with the banking system in Europe, and the big end of town using that fear to drive more selling so they can pick up a lot more stocks easily. Remember, I always have two scenarios on our stock market. What if it goes up and what if it goes down? And this is what you need to look at all times. You always need to have a process. Fear runs people's decisions. Fear and greed, as we know, runs the stock market. And if you're fearful, that means you don't have a strategy. That means you don't have a process, or you don't trust the strategy or process you have, which is pretty much the same thing.